It's a three-pronged trade front, right? We got potentials in Europe. We've got this steel and
Latin
aluminum in
America.
Latin America. Now you've got, hey, maybe we'll wait a year to get this deal done. How do you navigate and advise your clients through this almost every day?
It's like a gray cloud that's hanging over us, right? Because trade does have the ability to drive markets. And over the past several weeks, or you could even say the past couple of months, that positive rhetoric has been driving markets. And the reason for it is it matters. So if we were to have full-blown tariffs, it could take global growth from 2.9% down to 2%. It could completely erase the $700 per U.S. family that were received in the 2018 tax reform. So what are we advising our clients to do? Actually just stay the course and avoid market timing. You could have a tweet that basically tells us we're close to a trade resolution, the markets rally. You have something like we saw this morning, the markets sell off. So stay invested. And here are some pretty sobering statistics. We did an analysis of the past decade. If you missed the top 10 best performing days, it would have taken your per annum return from 8.5% down to 1.3%.
Wow.
If you missed the top 20 days.
In a decade.
In a decade. The top 20 days, top 20 trading days, you're in negative territory. So stay the course.
You've wiped out a decade of gains.
A decade of gains.
In an amazing bull market by missing 20 days in 10 years.
In 10 years.
Okay, so that said, there's three scenarios that seem to be out there right now. And please tell me if I'm wrong.
Yep.
Number one is we get the new tariffs on China December 15th, and we get new European tariffs. Scenario two, no Europe, we make some kind of a deal there, but we do get China. Number three, we don't get anything new. We get some kind of peace offering. So double whammy, single whammy, no whammies. Do we change our strategies for those scenarios?
At this point, it's hard to make any portfolio decisions based on that because the probability is really unknown. So the last scenario that you mentioned is kind of status quo. That's where we're at.
That's where we are now, and things have been pretty good.
And it's actually where we've been at for, like I said, the past couple of months. It's just the market
feels like.
The market has this reaction that if things feel like they're going in the right direction, we'll see a slight rally. If they feel like they're falling apart, we'll then see a pullback. In terms of tariffs, yeah, that's going to have an impact on markets, and we would expect.
What if we get the full whammy? We get Europe, we get new China, we've got Brazil, then what?
Look, that's not our base case.
We buy protection. How do we protect ourselves?
I think one thing that the market is giving us the opportunity is when you look at volatility, we'll have to look at where it is this morning, but when you look at volatility over the past several weeks, it's actually been really muted. So one of the things for clients who are nervous about staying invested, one of the things that we recommend is just buying protection. With volatility relatively muted, you can buy protection. You can basically use the dividend yield on your portfolio to buy protection and get you through the next couple of months and even the next year. Yeah. So that's a way to confidently stay invested.